Hello, I'm Natalie Miller, Director of Strategy for Parametric's direct indexing solution, Custom Core. Direct indexing is an alternative to mutual funds and exchange-traded funds, or ETFs, that offers more choice, greater flexibility, and potential tax advantages well beyond the scope of fund vehicles. With direct indexing, investors directly own the securities that compose an index and can customize those holdings to reflect environmental, social, or governance metrics, or to incorporate tax management strategies like tax loss harvesting. With Custom Core, clients receive exposure to an equity benchmark, such as the S&P 500, by directly holding the underlying securities in a separately managed account, or SMA. Parametric strives to manage that SMA to deliver benchmark-like returns with an expected annualized tracking error around 1%, as well as potential tax benefits from harvesting losses throughout the year. Third-party research has shown that this approach to tax management can enhance after-tax returns by as much as 1% to 2% over and above benchmark returns. We want to spend some time today discussing the impact of bear markets on tax management. Let's first define tax loss harvesting. In a well-diversified portfolio, there will always be securities that decline in value from their purchase price. Those securities are sold, realizing the loss. Those losses can then be used to offset realized gains elsewhere in a portfolio. Naturally, tax loss harvesting works best when losses are the greatest, so bear markets actually present the greatest opportunity. Let's take a closer look at Parametric's approach to capturing tax benefits during fast-moving, volatile market environments. First, Parametric employs daily monitoring, so we can take advantage of opportunities as they arise. Second, we only trade when there is sufficient opportunity to add value that justifies the inherent costs of trading. This is trigger-based loss harvesting, in contrast to scheduled, calendar-based approaches that might be quarterly, monthly, or daily. The actual frequency of trading depends on the share cost basis and the market volatility. In periods of higher volatility, we trade more often because of the increased opportunity set. Third, accounts are not frozen from trading because of wash sale rules. Instead, we implement date logic at the individual tax lot level. This prevents wash sales in stocks that have been recently traded, while leaving remaining stocks free to be harvested opportunistically. Frequency of loss harvesting is a balancing act, especially in volatile markets. On one hand, infrequent loss harvesting certainly isn't optimal. To see that, you only need to look at the COVID stock market crash of early 2020, one of the quickest crashes and recoveries on record. The market had actually more than recovered by the end of the year. So if an investor had harvested losses only at year-end, they would have completely missed out on some rich loss harvesting opportunities. You might think, if more frequent loss harvesting is better, daily loss harvesting must be the best, but that's not necessarily the case. Portfolio performing tax loss harvesting daily will naturally trade more often than a portfolio using trigger-based tax loss harvesting. Even though U.S. trades are typically commission-free, trades have an implicit transaction cost because of a bid-ask spread and market impact. At any given time, the bid price, or the price a buyer is willing to pay, is less than the ask price a seller is willing to sell it at. This difference can be thought of as the fee collected by the market makers that facilitate trading by holding an inventory of the security. And some fraction of this difference in prices is effectively paid whenever security buys and sells happen. So transaction costs increase with daily loss harvesting, but there's something else at play too. Daily loss harvesting can be too quick on the draw, selling securities or harvesting losses that continue to fall. To illustrate this concept, consider a stock purchased at $100 a share, which then goes up to $105, comes down to $103, goes up to $104, and comes down again, this time to $98. Which is below the purchase price of $100. In a daily loss harvesting account, the security would be sold at $98, realizing a loss of $2. But what if that security continues to fall in price, say down to $95, then $90? There's nothing to be done since the account doesn't hold it anymore. In the case of trigger-based loss harvesting, the security would be sold when the losses outweigh the gains of trading, which has the additional benefit of holding its tax lot until the losses become more meaningful. So basically, instead of harvesting low levels of losses, investors might be better off waiting until they're a bit deeper. That's a shortcoming of daily loss harvesting that Custom Core trigger-based tax loss harvesting addresses. For more on direct indexing, click the links at the end of the video.